morning, everyone, and welcome to our Exchange webinar series. This morning's webinar will present a deep dive into Maine's latest economic forecast and how it impacts your business. I'm Curtis Picard, President and CEO of the Retail Association of Maine. We are pleased to be co-hosting this morning's webinar with the Maine Grocers and Food Producers Association. We are honored to have the state's expert on the latest consensus economic forecast with us here today. To start off, we will hear about key trends that shape the state, such as inflation, the workforce and employment shifts, and migration patterns. We will also delve into the economic uncertainty surrounding recent federal actions and the impact of tariffs and what they mean for both consumers and businesses in Maine. Lastly, we will have a short question and answer portion at the end of this morning's presentation.
Good morning. My name is Christine Cummings. I'm the Executive Director of the Maine Grocers and Food Producers Association. We're excited to be co-hosting this morning's event and bring you all the latest information on Maine's economic forecast. The report was just released on Tuesday, so it's hot off the press. We're delighted to bring you this important and timely information from Amanda Rector as we look ahead to the rest of 2025 and beyond. So we want to take a moment and thank our series sponsors. So all of these companies have graciously supported the work of both the Retail Association of Maine and the Maine Grocers and Food Producers Association. They include Hannaford Supermarkets, Associated Grocers of New England, Poland Spring, Altria, Shaw Supermarkets, Bizzuto's, C&S Wholesale Grocers, HP Hood, Coca-Cola Beverages Northeast, and Pepsi. So I will hand it back over to you, Curtis.
Sure. Joining us this morning is one of my favorite presenters. We'll hear from Amanda Rector, who is the State Economist for Maine. Amanda provides critical analysis of the state's economic and demographic trends to support informed policymaking. As a key member of Maine's Revenue Forecasting Committee and the governor's liaison to the U.S. Census Bureau, she plays a vital role in shaping the state's economic outlook. With nearly 2 decades of experience in state government, Amanda has been instrumental in guiding Maine's fiscal and economic strategy since her appointment as state economist in 2011. Amanda holds a bachelor's degree in economics from Wellesley College and a master's in public policy and management from the Muskie School of Public Service at the University of Southern Maine. I truly appreciate her intelligence and ability to make complex economic data relatable and understandable. With that, again, welcome to the Exchange webinar series, and we will now turn it over to this morning's guest speaker, Amanda Rector. Amanda, feel free to take it from here.
Great, thank you. Good morning, everyone. I am going to talk this morning about the economic outlook, and I'm going to cover a bunch of different things. I thought sort of laying out where I'm going to go for this morning would be helpful to start things off. So I'm going to talk about population and migration first. I'm going to talk about housing because that's been an important topic related to population and migration recently. I'm going to talk about labor force and employment, wages and income, and then we'll get into inflation, consumer and business sentiment, and then some of the larger macroeconomic conditions. And I'll touch on the most recent forecast from the Consensus Economic Forecasting Commission in a couple of different places throughout here. But I'm going to start out with population and migration. And I'm going to start with sort of where we've seen changes since the last decennial census. So 2020, you'll remember in the decade leading up to 2020, we had pretty slow population growth as a state. The population grew just 2.6% from 2010 to 2020. And then the pandemic hit and we became a lot more popular and a lot more people wanted to move into the state. And so we saw population growth really take off because of migration. Particularly 2021 and 2022, domestic migration was very, very strong. It was more than enough to offset the natural decline that we have. We have more deaths than births each year. So if there were no migration, our population would actually be shrinking. But we've had enough people moving in to offset that. We had very strong growth in 21, very strong growth in 22, led primarily by domestic migration, people moving to Maine from other parts of the US. That slowed a little bit in 2023. 2023 nationally was sort of the return to normal when birth rates, death rates, migration all sort of started to go back to levels that we would typically see as opposed to the unusual years of the pandemic. 2024 is the most recent data that was just released in December. So we saw that continue to decline a little bit in terms of the migration. It was more than enough to offset the natural decline again. So we did still see population growth. What was interesting is that it was actually evenly split between domestic and international sources. So that international piece had been increasing over a few years, where the domestic piece had been decreasing. So overall, from 2020 to 2024, we actually have already exceeded that population growth that we saw the whole previous decade. So the population increase was 3.1% from 2020 to 2024. And I also like to point out that in 2024, we did actually cross that 1.4 million threshold. We've been calling our population 1.4 million for a while. We were just under that. We were sort of rounding up, but now we're actually over that. So 1,405,000 and change. So if we look around the state at the most recent year, when that migration component was starting to slow, what we see is that the counties that are sort of the larger, more urban kinds of counties, Cumberland, Androscoggin, York, Kennebec, Penobscot, those had higher rates of population growth. If you look down towards the right-hand side of this, there were a handful of counties where the population actually shrank. Most of those are sort of the more rural counties, but you've got my home county of Knox in there, which is a mid-coast county. Lincoln County is pretty close to that line. And in a lot of the cases, there were very small net migration numbers. So if you look at Aroostook County, that blue line is very small. It was just not enough to offset the natural decline. Knox County, Oxford, similar sort of patterns, not a lot of migration. Now, I'll point out that in Knox County, I think it's not so much about people not wanting to move to the area. And in some of these other counties, it may be the case as well, but it really is more a matter of housing not being available. So this has been sort of a limiting factor on migration recently. The other thing that I wanted to say about migration, so we think about Maine's demographics, we talk a lot about the fact that Maine has the highest median age of any state. But that migration that we saw during the pandemic actually had an impact. So if you look at the chart here, Maine is that orange line down at the bottom. So our median age actually dipped a little bit before coming back up to sort of where we were. So 2023 and 2020, we don't have 2024 data yet. We'll get that later this year. We're actually the same. At the same time, the US and all of the other New England states continued to see median age increases. So we're still the oldest, but we've actually closed that gap a little bit. And that was because the population moving into the state was younger than the existing population. So it was enough to bring down that median age a little bit and then sort of hold it steady, whereas everybody else has been seeing these increases. So, of course, why do we have the oldest median age? We also have the highest percent of the population age 65 and over of any state. We also have the highest percentage of baby boomers in our population. So the baby boom generation born between 1946 and 1964, that's the biggest generational age cohort in Maine. So this is a population pyramid for Maine from 1950. The base of this pyramid is very wide. Each one of those bars represents the percent of the population in a different age sex cohort. So in 1950, all of the baby boomers were under the age of 5, and there weren't a lot of people living over the age of 85. So the top of this pyramid is very narrow. It's shaped roughly like a pyramid. That's where the name comes from. If we look ahead through the decades, you'll see that there's this bulge of the baby boom generation moving up through the age cohorts. So if we stop at 2023, that's the most recent year of estimates that we have available. The baby boom generation is between the ages of 59 and 77. So not quite up into those uppermost age cohorts yet. That top one has been expanding because life expectancy has been increasing over time. There's also a bulge that sort of runs from 30 to 44 years. because the baby boom was so large, when they had kids, that created a little baby boomlet, even though birth rates were lower. That's essentially the millennial generation there. So you can see the baby boom generation moving solidly into those traditional retirement ages. The generations that follow are smaller. If we look ahead to the future, now these are brand new projections. I've just finished them. I haven't even published them yet. So this is sort of a little sneak preview of the updated projections that I have coming out. If we look ahead to 2032, this trend is expected to continue. So the baby boom generation will be 68 to 86 years. So just starting to nudge into that topmost age cohort, but solidly into those traditional retirement ages. The full cohort will be in those traditional retirement ages in 2032. This does not look so much like a pyramid anymore. One of my teammates calls it an acorn. I'm not even sure it's really acorn shaped, but it's sort of an upside down pyramid now. And that's a reflection of the fact that over the decades, we haven't had the migration in of younger age cohorts to offset the aging of that baby boom generation. So I mentioned housing earlier. As we saw migration into the state pick up, we saw a lot more demand for housing. And we've seen sort of a diminishing supply over time. We haven't done a lot of home building. There wasn't a lot of demand for it because we didn't have a lot of population growth. So if you look at the chart, this is active listings. So it's sort of a representation of how much housing is sort of sitting out there on the market available at any given point in time. It's very seasonal. Everybody lists their house in the spring. Nobody wants to move in the winter. So you get this wavy pattern going on. So you can see even before the pandemic, the start of the pandemic is sort of that gray bar there. You can see that we had this downward trend. The pandemic hit, we continued that downward trend, and then we've leveled off. More recently, we have seen some improvements. We've started to come up on a year-over-year basis, but considerably lower than we were previously. So we saw higher demand for housing, and then we saw mortgage rates and prices increasing, which meant that people were sort of locked in if they had a lower interest rate, so they weren't moving around into other homes and putting their existing homes on the market. So this sort of froze up some parts of the market. So we've seen this challenge flow through to prices, not just in Maine, but in New England and the US. Prices increased everywhere pretty dramatically during the early part of the pandemic. That growth rate has come down. It is still growth. I'll point out we're above that dark black line at 0%, which means there's still price growth. It's just not as fast. And Maine had been, for a period of time there, much higher than the US and New England. We were first a couple points in time there. We have come down a little bit. The most recent quarter here, we've ticked back up above the US again, back on par with New England. But we are starting to see some relief in terms of home price growth. It's been really challenging on the affordability front. If you look back to 2020, there were a handful of counties that were considered affordable that I've color coded those green. Mostly more rural counties. At the high end there, Lincoln County, Cumberland County, up around 60% of households were unable to afford the median home based on median incomes in those counties. If you look at what 2023 looked like, all of those price increases really drove this unaffordability. Nobody was considered affordable anymore. Lincoln County, Knox, York County, up closing in on 90% of households unable to afford the median home. Down on the low end, Aroostook County there is where Lincoln and Cumberland counties were back in 2020. So this has really been a limiting factor on migration. If people are going to move to an area, they need a place to live. And this has been very challenging. Good news, I think, is that everybody has recognized that this has been a challenge. And so a lot of people from lots of different sectors, public, private, federal, everybody's been sort of trying to work on this issue, trying to get more housing into the market and then also help with some of the price pieces. So let me switch gears. I want to talk about labor force and employment next. And I thought I would start with the big picture, sort of who is in the labor force. And we start with the population that is age 16 and older. That and older is the really important part because there's no upper age limit. So we take everybody 16 and older. And then we say, okay, are you working? You're working? Great. You're employed. That's easy. That's about 96.9% of the labor force in Maine. You're not working. Okay, so why are you not working? You're just out on vacation today or you're homesick. Well, you're still employed. You're still in that 96.9%. Maybe you're on layoff awaiting recall, or you don't have a job, but you're actively looking and available for work. If you're in one of those two categories, you're unemployed. That's the other 3.1% of the labor force. Those two pieces, employed and unemployed combined, that's the whole labor force. That's 60.6% of that age 16 and older population. So you're not working, you're not just out from your job, you're not on layoff, you're not looking for work, you're not any of those things, then you're not in the labor force. That's the other 39.4%. So who does that encompass? What are the reasons that people aren't in the labor force? So this is national data. I'll point out that think about Maine's demographics. Nationally, 52% of the people who weren't in the labor force were retired. In Maine, because we have an older population, that's an even more important share here, an even larger share. Some of the other reasons, maybe you're in school full time, especially on the younger end of that 16 plus. There might be health or disability reasons, home responsibilities, full-time caregivers, and then some other reasons. That's that little 3% sliver there. I mentioned the fact that because we have an older population in Maine, retirement is a larger share here. Nationally, 3/4 of the difference in non-participation, so 3/4 of that increase in why aren't you in the labor force from 1999 to 2022 was due to retirements. So that is a growing share. So when you think about the reasons that people aren't in the labor force, that retirement piece is a really, really big component of it and an increasingly large component. So if we look at the overall labor force participation rate for Maine and the US, and we look back 20 years ago and then stop before the pandemic hits, you'll notice that for most of that time, Maine was above the US. We had a higher labor force participation rate than the US. That changed just before the pandemic. We dipped down below. Both Maine and the US have sort of a downward trend over this period. And then the pandemic hit and things went haywire. The US came back up sharply at first and then sort of a gradual increase. It's leveled off. It's actually started a little bit of a downward trend again. Maine saw some ups and some downs, and then we have seen a little bit of gain recently. It's leveled off a little bit the last couple of months, but we've opened up this big gap with the US. But I'll point out, if you take that trend from 20 years ago through to the pandemic and sort of pretend the pandemic didn't happen, just extend that trend forward, we're really not that far off where you would expect us to be. We were expecting to see a gap open up between Maine and the US because of our demographics, because we have that older population and a larger share of people moving into that out of the labor force from retirement reasons. So you can see this, if you look at the labor force participation rate by age for Maine and the US, and you just looked at this chart, you'd say, well, Maine does at least as well as the US everywhere. We actually do much better than the US on the young end. So, okay, Maine's labor force participation rate, if you were just looking at this, you'd think it's got to be at least as good as the US, but it's not. We just saw that on the previous chart. That's because of this chart. This is the share of the 16 plus population by age. We have a much higher share of our population at those upper age cohorts where that labor force participation rate is so much lower. And so that impacts our overall labor force participation rate and is driving that gap between Maine and the US. At the same time that we have this diminishing labor force, we have very, very low unemployment rates. For Maine, in February, the seasonally adjusted rate was 3.5%. That's below both the US and the New England rates. It's been pretty steady lately. not a lot of fluctuation. That's a very low rate. If you look around the state at the counties, this is not seasonally adjusted data at the county level. February tends to be a pretty high unemployment rate month. The highest rates here, I think Washington County was the highest at 7%, Piscataquis County 6.8. Most of those are still pretty low unemployment rates for sort of the high point in the year. Most of the counties saw an increase from a year ago. So unemployment rates have come up a little bit from where they were a year ago. In some cases, that's actually because we've had more people in the labor force, which is a good reason for unemployment to go up. But there's also been some slowing of job hiring in some areas too. If you look at the trends statewide, the southern coastal, mid-coast, central, sort of that I-95 corridor of the state tend to have the lower unemployment rates. And the more rural parts of the state around the rim counties, as we think of them, tend to have the higher unemployment rates. So this situation with our demographics and what we've been seeing with the labor force has had an impact on the employment forecast. So this employment forecast comes from the state's Consensus Economic Forecasting Commission. It's a group of 5 independent economists. They meet a couple times a year to set the official economic forecast for the state. My office provides staff support to them. They have been thinking about this demographic situation for a while. And when they combine that with all of the uncertainty that we have going on in the economy right now, their forecast for employment growth is pretty much just flat. So we did get back to pre-pandemic peak employment in summer of 2022. We grew strongly in 2023. We saw growth again in 2024. But then this forecast just sort of levels out. This is a little bit flatter than what they had in their previous forecast. They definitely had a plateauing, but they've brought that down a little bit. So the growth rate in those out years there, 2027, 2028, 29, it's just zero. They're not expecting any growth. And that's because you have to have not only demand for workers, you have to have a supply of workers to actually grow employment. If we look at employment by industry, a couple of things that I want to point out here. So trade, transportation, and utilities is the largest employment sector, a little over 18% of the state's employment. Most of that is retail trade. If you look at the trend the past couple of years and sort of 2020, it's been decreasing as a share of the state's employment, not by a lot. It's still the largest and still above 18% there. Healthcare and social assistance is next. That has finally started to recover from the really hard time that had during the pandemic. Government is next. Government, I'll point out, includes federal, state, local, K through 12 public education, public higher education, so community college, university system. It's a lot when you get all of that put together. The next two are the other ones I want to talk about. So professional and business services saw consistent growth here. It's leveled out the past couple of years in terms of the share of the state's employment. Leisure and hospitality just after that. Back in 2019, leisure and hospitality was just a little bit larger than professional and business services. It's pretty much the same, but leisure and hospitality had a few more in jobs. That was hit very, very hard during the pandemic. It's come back up, but you'll notice that it swapped positions with professional and business services. And so that trend is expected to continue in the future and not really supposed to switch back again. So there are some larger shifts that are happening, not just in Maine's economy, but nationally, where professional and business services has been an increasingly important part of the economy and the economic picture. The other thing I'll point out is that a lot of the remote work that we saw coming into the state was in that professional and business services sector. And so that contributed to a lot of the growth in that. So thinking ahead to the future, how do we find enough workforce there are a few different pieces to this, and it's going to take all of the pieces. It's not going to be we just do one of these and we're set. So migration is certainly a piece of it, continuing to attract workers to Maine. I mentioned earlier, housing is currently a constraint on that side. If we think about retirements and we think about the fact that a lot of our population is moving into those traditional retirement ages, if we can keep them engaged in the workforce, maybe not full time, maybe it's part time, maybe it's more remote, maybe it's seasonal, all of those things can help sort of fill some of the gaps in the workforce and keep folks engaged longer. We can also think about labor force participation more broadly and think about, okay, who are some of the historically underemployed populations in the state? Are they veterans? Are they new Americans? Are they people with disabilities? Are they long-term unemployed? What are the roadblocks that are preventing them from really participating fully in the labor force? And what can we do to get rid of those roadblocks to help them engage? And then finally, automation, thinking about using technology to substitute for labor. Now, I say this, and nowadays people immediately think of AI. That's sort of where things are evolving right now. The idea of using technology to substitute for labor is something that we have done right straight along. I mean, from the invention of the wheel, this has been something that has always happened, is that, technology evolves, we adapt to it, and then technology evolves further and we adapt to that and allows for more productivity. So this is one of the other things that we're going to be able to do to help find workforce in the future. I'm going to talk about wages and income a little bit. During the pandemic, we saw a very sharp upward tick in average wage per job. If you look at the orange line, that is after adjusting for inflation. And you can see it was sort of pretty flat for a while, came up a little bit, started to move up before the pandemic. Inflation was very, very low. There was upward pressure on wages from that tight labor market. Then we saw a really sharp uptick. And then inflation, of course, picked up and it sort of leveled out. Now, the fact that wage increases kept up with inflation is pretty impressive. That actually meant that we closed some of the gap. We tend to run behind the US on average wage per job. We closed some of that gap because we were able to keep up where some other states were not. So we've seen now this, we're back in that sort of steady state as wages kept pace with that much, much higher inflation. So, excuse me, I want to touch just briefly on the components of personal income. This is now total personal income for the state, sort of a broad economic measure. This is an individual or household income. The largest component, if you look down at the bottom, 2019, sort of the standard mix, pre-pandemic, 44% wages and salaries, 21% personal current transfer receipts, which is a not helpful name at all, but monies that get transferred from a government to or on behalf of an individual. 18% dividends, interest, and rent, 11% supplements to wages and salaries, 7% non-farm proprietors income. During the pandemic, we saw this shift a little bit. So I've highlighted two key quarters there, the second quarter of 2020, the first quarter of 2021. We saw wages and salaries were a smaller share, transfer receipts were a larger share. And I'll talk about that in just a second about why that happened. But where are we now? So 2024, the most recent year, we're back to sort of the standard mix. Wage and salaries a little bit smaller. One of the things I'll point out is that as people age, they're aging out of a wage and salary and into more often a transfer receipt or dividend, interest, and rent. So demographics are playing a role in this mix. And you can see that in particular if you look at the components of transfer receipts, again, down towards the bottom there, 2019, that's the standard mix. 35% Social Security, 26% Medicare, 19% Medicaid. That's really the bulk of it. And so if you think about an aging population, you have more people collecting Social Security, more people collecting Medicare. This is an increasingly important part of total personal income. There's a little 1% sliver of unemployment, 13% everything else. Again, during the pandemic, and that's those two highlighted quarters in the middle there, 2020 and 2021, there were not actually fewer people collecting Social Security, Medicare, Medicaid, even though those were smaller shares. What happened was those other shares grew a lot. In particular, if you think about the stimulus checks that went out, child tax credits, PPP, all of that stuff showed up in that other component. So again, we saw this big shift. Where are we now? Well, we don't have the annual 2024 data yet. If you look at 2023 annual down at the bottom, or the third quarter of 2024 up at the top, pretty much back to normal again. All of those programs have gone, and now we're back to sort of this standard mix. In terms of the forecast here, and again, this is coming from the Consensus Economic Forecasting Commission, this is adjusted for their inflation forecast. So the expectation here, 2025, they do have some growth in wages and salaries and personal income. It's a little bit lower. They've brought their forecast down a little bit. Part of that is because they actually brought their forecast for total personal income down, but part of that is also because they brought their inflation forecast up. And then coming back up and then sort of staying at that 2%, which is sort of longer term flat level growth. So let me talk about inflation next, along with consumer and business sentiment. If we look at inflation, this is consumer price index inflation. The black line there is the actual all items growth, year over year growth. And you can see where we started the pandemic basically at 0, and then it went up and up and up and up and up, and it peaked in June of 2022, and then started to come down. And then it sort of stalled out, that downward movement. It's come down a little bit, but it's been pretty sticky over the past couple of years here. That is not deflation. That is growth at a slower rate. I just want to make sure that people understand that even though it's come down, it's still growing. It's just not growing as fast as it was previously. If you look at the colored bars, those are the components of that change. And so those are the different things that are making up this inflation. You can see during the peak years there, peak months during the pandemic, it was coming from a lot of different sources. It was a big mix of everything. More recently, we've seen the largest contributor be shelter. Shelter is really contributing to inflation, that those high home prices that have continued. We've actually seen occasionally some decreases in some of the components. So we've seen energy prices come down a little bit, some used vehicle prices come down a little bit. So shelter is really the driving factor at this point. The Fed, the Federal Reserve Bank, of course, when they saw inflation going up, they started to work to bring it down. That is their task. And so they increased interest rates to try to bring inflation down. That's how that works. Their current target range is 4.25% to 4.5%. They did not change that at their most recent meeting in March. If you look at their median projection for this year from 2025, from their March meeting, it was 3.9%. So they've got one or two potential interest rate cuts built in at this point in time. But what I've included here, I think, was a really telling chart from that projection. If you look at the dotted lines in those two charts, that represents where things were in the December projection. So in December, uncertainty about GDP growth, sort of, we think it'll be about the same, and then maybe a little bit higher. If you look at the March projections, much, much higher uncertainty about GDP growth. If you look at the chart on the right-hand side, that's risks to GDP growth. In the December forecast, it was mostly broadly balanced, a little to the upside, a little to the downside. In the March projections, it is solidly weighted to the downside. So there's more risk, and that risk is on the downside. So even though they didn't really change anything very much at that meeting, definitely the expectations about uncertainty and risk have changed. The Economic Forecasting Commission, as I just mentioned, brought up their forecast for inflation. So 2024 inflation came in at 3%. They are now actually projecting that we're going to see it a little bit higher in 2025, 3.2% for 2025, coming down to 2.8% in 2026 before we drop back down to 2.2, 2.1 in the out years there, closer to that 2% mark. So that is a reflection in part of the expectations around the tariff situation. All of the uncertainty and in particular expectations about higher inflation have been weighing on consumer sentiment and small business optimism. If you look at the blue line here, that is consumer sentiment. It saw some very sharp declines the past couple of months here. That is based on deteriorations in future expectations, particularly around higher inflation, excuse me. The orange line is small business optimism. You can see that jumped up after the election. That since has come down a little bit, and that is reflecting that higher uncertainty and again, higher inflation. So let me wrap up with macroeconomic conditions. This is sort of all the big picture stuff that's going on. And if there were one word, during the pandemic, the one word was unprecedented. Right now, the one word is uncertainty. And I've included, this is a quote from the April CEFC report, Consensus Economic Forecasting Commission report. There is considerable uncertainty at this time around economic policy, government spending, geopolitical tensions, and consumer sentiment. Lots of uncertainty in lots of different areas. So I just wanted to highlight a few of the key assumptions that were in that report, because these changed pretty significantly from their previous report. And understanding their assumptions can really help you think about these are where the risks are. These are the things that if they change, might change the forecast. So geopolitical tensions remain elevated. That was an existing assumption. But what changed was some of the other language, particularly around the fact rapidly changing tariff policies are contributing to the possibility of a global trade war. And then talking about additional uncertainty coming from some of the strained relations between the US and China, European nations, Canada, and then the risk of escalating tensions between China and Taiwan. The federal government has entered into a period of significant fiscal austerity. So there is a lot of federal funding that comes into the state through a lot of different paths. We're not just talking about federal monies that go to Maine state government. Federal funds go through to individuals through things like Social Security, contracts with nonprofits and businesses, grants to higher education, research institutes. So there's a lot of federal funding that flows through a lot of the economy. And there are, of course, multiplier effects from that. People who are receiving those funds, Social Security, wages, businesses are then turning around and spending those monies in the economy. A lot of that is local. So any reduction in federal funding is going to impact the state's economy. Inflation growth remains elevated above target levels and will face upward pressure from tariffs. And that, of course, has weighed on consumer sentiment as expectations about future personal financial well-being have deteriorated. And then finally, Maine may be at greater risk from federal funding and tariff policy changes. We have seen some targeted impacts from the federal government, along with a lot of sort of national impacts from federal changes. And then the tensions between Canada and the US may also drive a decline in Canadian tourism to Maine. That was another thing that they were thinking about, even beyond sort of tariff impacts, there are tourism potential impacts as well. Tariffs. This was what I had written yesterday. And then, of course, last night we had a big release on new updates to the tariff situation. So while Canada, Mexico, and China have been the primary targets, and of course, Canada is Maine's largest trading partner, There were a lot of new tariffs that were announced in terms of these reciprocal tariffs. So some things went into effect today. We saw tariffs on cars go into effect. Parts are going into effect in another month. Steel and aluminum are in effect now. There were a lot of reciprocal tariffs that were announced, 10% on everyone, taking effect April 5th, more on select countries taking effect April 9th, 20% on the EU, 24% on Japan, 34% on China. That is on top of an existing 20%, 46% Vietnam, 26% South Korea. There's a list out there. There is still, even though all of this was announced, there is still a lot of uncertainty trying to figure out exactly how these are going to play out. A lot of people were taken by surprise at how large they were. Other countries are now figuring out how they're going to react. So this is the kind of situation that could potentially set off some sort of global trade war. I will say, if you think about tariffs more broadly, the higher the rates are, some of these are very high, on a broad base, and again, these are broad based. For a long time, we don't know so much about that yet. And in places where there are few substitutions, and that's sort of a mixed bag. Some of these things are things that you could substitute for, whether that's you find existing local replacements or onshore manufacturing. Not everything can easily be substituted or onshored. We don't have everything we need here. So when you have that combination of higher rates on a broad base for a long time with few substitutions, you get a larger impact to your economy. I think one of the challenges right now is related to the fact that all of this news and talk about tariffs, higher inflation coming from those tariffs, there's going to be a big psychological effect on the consumer sentiment line. It would not surprise me to see that go down again next month. And if people are feeling really uncertain, that can lead to a lot of economic effects. That consumer sentiment can sometimes be a leading indicator. So I think that's where one of my concerns is right now, is not just the actual tariff impacts, which will be significant and we're still trying to parse out, but also the impacts on people and businesses sort of more psychologically. So a few things to keep in mind before I wrap up and we can take some questions at the end here. We did see migration pick up during the pandemic. The continuation of that trend, though, has been challenged by the availability and affordability of housing. This is contributing in part to this employment growth challenge. So employment growth really is limited by labor force availability. You need to have people to fill the jobs, although there is now also larger economic uncertainty, which might be limiting employment growth. If you can increase labor force participation, if you can continue to see in-migration of younger populations, if you can increase productivity, that can help with filling the gaps around the labor force availability piece. Economic uncertainty is extremely high. I cannot understate that, particularly related to federal policies. And there are a lot of different federal policies. I really only touched on a couple of things. There are other things going on too. All of that uncertainty is very, very bad for the economy. Economies do not like uncertainty. In some cases, it doesn't even matter what the policy is. It's more about the stability of the policy than about the policy itself. So when you have a lot of uncertainty, a lot of things changing very rapidly, that is a detriment to the larger economy. On the plus side, Maine does have a robust budget stabilization fund, also sometimes called the rainy day fund. It's around $900 million. That provides a really valuable cushion to the state in case there is some sort of an economic slowdown or revenue shortfalls. This provides the governor and the legislature time to make adjustments without having to just sort of stop everything slash left and right without some sort of a plan. This allows for some time for planning. So that was a lot of charts for first thing in the morning. Thank you for bearing with me. I've put my email on this last slide. Feel free to reach out to me if you have questions. I also put our website on here. We're doing a lot of new things with our website. We've been adding some interactive charts and dashboards. We have some signups for newsletters. We publish a monthly economic indicators report. You feel free to go and check it out. You can also get to the full Consensus Economic Forecasting Commission report on that page. If you're interested, go to our website, and then you'll see a portion for economic forecasting if you are interested in reading the full report there. And I am happy to take any questions that have come up at this point.
Well, thank you so much, Amanda. We really appreciate that. That was a lot of information for early in the morning, but as Curtis said, we certainly appreciate your ability to put it in terms that we can all easily digest. And so just a reminder to folks that if you do have any questions, you can use the Q&A box at the bottom of the Zoom platform. And we do have a few questions that have come in, so folks can go ahead and add to those as we continue the discussion. First question is, which industries are facing the largest gaps in labor supply and demand that may put further pressure on net output productivity moving forward?
So that's, yeah, that's a good question. I will say that the availability of labor force is a challenge across all of our industries. I do not talk to any industry where they're like, oh yeah, we've got everybody we need, we're fine, we don't need more workers. Everybody is facing this challenge. And I think that, you know, as you think about industries that are more readily able to adapt to technology shifts, I think that's where you're going to see some productivity gains that are going to allow for innovation. I think the idea that you know, there are some things that we've always done in person or physically. I think there, even within sectors that are still very labor intensive, there are opportunities to find ways to supplement with technology so that you can do more with the people that you are able to get. And I think about things like healthcare, and that there are things that can be done with technology in healthcare that can help relieve the burden from the people who are there, so that they are able to do the things that you can't supplement with labor, with technology. But there, I would say it's all of the industry sectors are facing this challenge.
Thank you. I like this next question because it's kind of retail related. The person is asking, how leveraged is the Maine consumer? And I'll follow that up with an additional question of, you know, related to tariffs and the uncertainty, you know, my larger retailers in particular are already starting to think about holiday purchases. You know, those usually happen in the first and second quarter, planning for the holiday season. How is that going to impact, you know, the retail side? And then the question is on the consumer side.
Yeah, that's a good question. I don't look at that figure all that frequently. I will say that we include sort of a debt type of chart in the background materials that we provide to the Economic Forecasting Commission. At this point, it doesn't look terrible. I would say that certainly the concern is that if these tariffs that are taking effect are driving prices up significantly in the short term, that could lead to a deterioration in consumer credit because it takes time for people to adjust to some of those shifts. But at least at this point, while certainly there isn't the same kind of um, excess cash on hand that there was during the pandemic, things are not as bad as they were sort of prior to that point.
You. I wanted to ask you to not get into the politics of it, but of course, this forecast is going to be used by state budget leaders in crafting this next phase of the budget. They've passed this essential services budget, and I think we've all been waiting with bated breath to see what this forecast is going to bring to policymakers in terms of how much additional state spending is going to happen. And as you've said, there's now this uncertainty at the federal level, and Maine certainly relies on a lot of federal funding, aside from the politics of what's going on. What can you share about where the state budget may be going and how that may impact our members and Maine people?
Yeah, so I am less involved directly with the budget process. I'm more on the steps before that. So we're the Revenue Forecasting Committee. Now that the economic forecast has been updated, revenue forecasting will meet the end of this month. April 28th, I think, is the date that we have for that meeting. I will say that if you look at the forecast updates that were made, there weren't a lot. They were relatively minor updates. They also were, bringing down employment, bringing down personal income, bringing up inflation. Um, that is not a particularly positive economic environment. So the revenue forecast is going to incorporate those economic changes, as well as there are often sort of other things that are happening in some of the other budget lines that are revenue lines, not budget lines, revenue lines that are impacted by other things going on. So we'll see. It's hard for me to predict what that's going to look like until I start seeing numbers from the Maine Revenue Services on the new forecast. I wouldn't expect really significant changes, at least based on the economic forecast. So sort of what we're projecting is probably going to be pretty close to what we will be projecting. So not a lot of changes. The uncertainty is a really, really big factor. The Economic Forecasting Commission talked about the fact that if things start to deteriorate in a way that they weren't expecting, they have the ability to call themselves back in and update their forecast, which would then bring the Revenue Forecasting Committee back in after that. So they have the ability to respond to changes in the economy sooner if that's necessary. But at this point, that amount of uncertainty is really challenging to grapple with. And I think that in terms of the budget side of things, that sort of that caution of you're facing a lot of uncertainty is something that's going to be a really important part of figuring out where to go. You want to be a, a little more cautious when uncertainty is high, and think about the fact that maybe you don't know exactly what's going to play out in the coming months.
All right, I'll just do another prompt for folks. If you have any remaining questions, we are looking to wrap at 9:30. I will ask another question. certainly see policies and recognize that folks are experiencing increased labor costs and driven inflation and rising prices. Can you talk to us a little bit about how those factors essentially become a cycle of inflation?
Yeah, so when people are, even if inflation hasn't happened yet, if people are anticipating inflation and higher prices, they're going to say, hey, I'm not going to be able to afford the things I need to buy. You're going to have to pay me more. And so wages go up. And then when people have those higher wages, then they're able to buy more, which can also lead to higher prices because there's more demand. And then that in turn can drive wages up. And you can get into a wage price inflation cycle. That tends to happen more when there are really rapid and abrupt changes. If you think about what happened during the pandemic, we saw really, really high inflation in a very short period of time. And so we saw a lot of wage increases that were related to that. There were other things going on too. That was not the only thing contributing to higher wages during that period. And certainly the demographic situation is a piece of that, because when you have a limited supply of workers, that's going to drive wages up regardless of what is happening with some other pieces of inflation. But uh, it certainly can be one of the ways that we see inflation and wages take off, is in one of those cycles.
Going to wrap up, but we did get just one other question in under the wire, so I'll make this the last question. With looming federal debt crisis and budget adjustments, what programs at the federal level that impact Maine's GDP are currently at risk to get cut or changed? In other words, what industries are at risk?
Yeah, oh gosh, I think this is where a lot of the uncertainty comes in. Things are changing so quickly on the federal level. You hear about something being cut or changed, and then the next day it's not that, it's something else. So at this point, I would say we actually just don't know, and that is that uncertainty is problematic in and of itself.
All right. Well, let's wrap it up here. A sincere thank you again to Amanda Rector. We really appreciate your time. We would like to conclude by again recognizing our series sponsors, Hannaford Supermarkets, Poland Spring, Shaw's Supermarkets, Associated Grocers of New England, Altria, Bazzuto's, C&S Wholesale Grocers, Hood, Pepsi, and Coca-Cola Beverages of the Northeast. Thank you to everyone for joining us today. This is going to be an evolving conversation. We encourage anyone who has any additional ongoing questions to please reach out to us. We will be sharing this recording. And once again, Amanda, thank you for your time. We hope everybody has a great day.